Forecasting future gold price potentials can be a pretty simple mathematical equation, with but a few stagnant and other growing data figure inputs required. A few dubious assumptions must be made at the onset of calculating a future gold price forecast. One then must tackle the questions of what percentage will the debasing fiat currency ultimately be accounted to, and what are the monetary-based measurements you will use to deduce the future figures. In this short video, we will break down the most widely used long-term formats to forecast the potential fiat US dollar prices for gold, and as a ratio subset, future potential silver prices as well. We'll also cover a few widely shared data points that make little to no long-term forecasting sense, so you become aware of them. Hello, this is James Anderson of SD Bullion, and we are about to coldly extract some emotion, shock, and mystery away from the potential high four and even five-figure fiat US dollar gold prices ahead, with some basic assumptions, inputs, and arithmetic. We'll use our nation's roughly every 50 to 60 year historic gold revaluation precedent as our guide. After all, precedent matters not only in financial history, rhyming, but it also matters in ongoing laws we rationalize and or twist. For instance, today we are again using in plain sight the 1934 Gold Reserve Act as a dubious lawful basis to rig any financial market anywhere at our so choosing, using the U.S. Treasury's Exchange Stabilization Fund, ESF for short, and the Federal Reserve's ability to leverage out taxpayer on the hook special purpose investment vehicles, or U.S. Treasury SPVs in short. But that's not the topic today. Let's digress. In our nation's last century and a half or so of financial history, gold and also silver too have in relatively short durations of time revalued sharply higher as a result of fiscal, monetary, economic, and financial crises. We are about to study the three most acute versions from the last two-thirds of our nation's history. The most recent version was in early 1980, but there was also a deflationary revaluation of gold in 1934, and shortly after the U.S. Civil War in the late 1860, we saw gold nearly tenfold in price, topping out near $200 an ounce, almost two full human lifetimes ago. A couple assumptions must be made at the onset of this current long-term gold price forecast calculation. In August 2017, U.S. Treasury Secretary Head Steve Mnuchin performed a one-day walkthrough tour of our Fort Knox gold, and we must therefore take him and his tweet that the gold is indeed safe at face value. Never mind that no one has audited it since the year 1953. For this calculation, we are going to assume official gold reserve figures claimed by the United States government indeed reflect reality. First, to begin, we must start with a common example of how not to try and value gold and silver's future long-term price potential. You can use this example to help critically think through misinformation that undoubtedly is going to be coming forth in the gold bubble mania beyond $2,000 an ounce coming. Many of you will likely recognize this US Debt Clock website. It's very interesting and has a fascinating number of data points you can go check out. I'll leave a link to it in the show notes. The most important number on that website is not merely the sharply escalating U.S. national debt, about to pass $25 trillion soon enough. No, it's the U.S. unfunded liability amount, which estimates range from 100 to over 200 trillion in net present value promised, but yet nowhere near close to safe for. Built on an assumption that's likely now financial bear market cannot deliver on. Staggering figures like these virtually guarantee both a major default and further fiat currency debasement cycle ahead, and possibly a currency crisis as an eventual outcome. Today we're going to focus in on the often pointed to yet barely understood dollar to silver ratio and dollar to gold ratio numbers plugged into this US debt website. Many people cite it, yet few give any context or thought as to how it's derived, much less why it's an inferior forecast, to what I will show you afterwards. US Debt Clock defines their dollar to gold ratio, or dollar to silver calculation, as the year-over-year increase in US M2 currency supply versus annual world gold or silver production of the year. And while this may give viewers a good understanding on the boundaries of the current theoretical unlimited or infinite fiat currency creation versus finite precious monetary metal production, it gives little insight into the inflationary debt subsidized seeds that have already been sown for now 4 decades running since the last gold silver mania phase in 1980. So while the Debt Clock website is interesting, steer clear from its gold and silver price forecasts. They are but a fractal of what is going on globally and what has happened in the past. In order to gain an insight into our future fiat US dollar gold and silver prices, we need to look to our past first, how this eventual revaluation for gold and then to typically laggard silver may come about again. The chart you're looking at reflects the full fiat U.S. currency supply based on their M1, M2, and no longer reported M3 measurements from the year 1970 to today in 2020. You can see over the last fiat-filled 50 years, we are virtually always expanding with escalating financial market interventions to prevent losses by deflationary default cycles. You can see we always inflate the fiat currency supply further, and it's also masked by productivity gains, advancements in technology and offshore near slave labor wages, price inflation for the things we most need, things like healthcare, quality housing, whole foods, higher education expenses, childcare, etc. Those prices are almost always constantly moving higher in nominal price, decade after decade. This calculation we are going to perform today, it starts to get a bit confusing and long-winded when we define and decide which monetary base aggregate we'll use in our calculations. I personally don't like hyperbole and outlandish suggestions, so I'm just going to lean on M0 shortly, the hardest fiat currency supply figure for our calculation. Any further gold reserve accounting of the M1, M2, or M3 figure respectively is simply bonus for bullion bulls. Note as we swing through these three charts, the 1980 low at the bottom of these charts in the blue line, those are the likely levels we are again headed to revisit as the fiat Federal Reserve note loses further credibility and purchasing power versus gold bullion to come. Now let's get into our calculation today. I'll leave links in the show notes below so you can go check it out all by yourself. Just in doing this exercise, today I personally learned that the hard M0 fiat Federal Reserve note pile has been increased over $500 billion in the last 6 months of time, and much of it pre-viral crisis. Perhaps some of it having to do with the repo bank issue that started in September 2019 and dwarfed any other repo crisis that happened before the 2008 financial crisis or the 2001. And it's only exacerbated with the economic shutdown in the last few months of time. Here are calculations as they stand today, and we're using again the conservative M0 portion. As well, the recent drastic increase in M0, it just adds fuel to gold's mania phase upcoming. The next question of asking yourself is, how's silver going to perform? And that's a question that we must key off gold's eventual price points and how dramatically the gold-silver ratio may fall. Given that we are at near all-time highs, above 110, according to the COMEX and London-driven spot prices, gold-silver ratio could fall drastically in the coming years. Given the average guy on the street, he basically looks at gold, how expensive it is at $1,700. In bullion, it's more like $1,800, $1900, $2,000 per ounce, given the shortage that's ongoing. They look at silver bullion as something that's easily more affordable and that they can easily get into, even at triple digits per ounce. In the year 2015, we saw 1 in 4 ounces of that year's physical silver supply go to silver investment demand. Basically, that year struck and sold silver bars, silver coins, silver rounds. We're likely going to surpass that as gold's price manias. The silver bullion bull should vastly outperform gold for a tight duration of a year, 2 years, perhaps even more. Ultimately, we don't know how bad the fiat Federal Reserve note devaluation could get, but historically, in such scenarios, physical precious metals buy a whole lot more in future values in terms of goods, services, and other asset classes. Last Western-led gold bullion bull market of the 1970s, the majority of the gains happened at the end, and they bought way more in terms of goods and services near the end in 1980 as they did just past the middle point in 1975, 1976. The fiat Federal Reserve note is readying to lose another battle to gold, with much higher per ounce prices ahead. The debasing inflationary seeds have already been sown, decade after decade already. If you want to go read about that, check out this article I wrote just a year ago. The price for physical gold ahead should eventually make 1934 and 1980 highs look like Cupro nickel coins versus a U.S. constitutionally defined dollar, respectively. If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on.